up ahead. Affirmative 612.
This week on the Wealthy Pilots podcast, Scott, IPOs, man. I mean, it's it's a big talk this week. At the time we're taping and dropping this podcast, we had the SpaceX launch last Friday, no pun intended. So let's talk a little bit about IPOs and just the hype around them and what to make of them, especially for investors, but really also retirees, pre-retirees. It's a little bit different animal too, but I think just across the board, a good conversation about this would be warranted. How are you, my friend?
Yeah, doing great, man. How about you?
Doing well. Glad you're back from your trip. You were just telling me you had an excellent time in Japan. That is awesome.
Yeah, I was overseas for some kind of, I guess, international business education, development, et cetera. And pretty amazing to see between Japan and Singapore, just, how the international markets work, some of the complexities there and what have you. So it was very, very insightful.
Yeah, and cool cultures as well. So.
Yeah, it was, aside from that, obviously you get to still see some sights and eat some unique food and all that kind of stuff. It was a great time.
Good stuff. Good stuff. Well, you didn't have to take a rocket to get there, but let's talk a little bit about SpaceX. And I guess I want to get in on that, right? I think that's, it's very exciting. People are like, oh, I missed out on Amazon or I missed out on Facebook or, whatever, right? When they go IPO. So talk to me about it.
Yeah, so it's interesting, when we think about what an IPO is, it's an initial public offering, right? It's when a private company goes public. And so it's interesting when you really look at like the history of IPOs and understand the process of how they work and getting into the market. It's very unique. And so, when you look back at the track records of IPOs, I mean, many IPOs grossly underperform after their initial offering.
They're very volatile, right?
Very volatile.
For the first bit. Yeah.
I mean, and SpaceX is very interesting when you look at how the company, pushed that offering out. I mean, they set a lot of records or made a lot of exceptions, I guess. I mean, they, put them into S&P 500 index funds and put them into the NASDAQ listing, well before they really, quote unquote, earned it. And I think it's just based off of, the anticipated hype, really. And so it's interesting when you look, I was just looking at the price today. It looks like a lot of the initial steam is wearing out. I think it's down about 5% today. But that IPO, there's an underwriting process that these companies go through that's very expensive. And, that underwriting process, they're trying to find a target price that they're going to list the stock at. Mm-hmm, and so many times that price can be, too high, it can be too low. And that can drive, overperformance or underperformance short term. When you look at the last, the last 30 days since it's been public, it's up 22%. That's a lot. Is that going to continue forever? Probably not. And candidly, when you look at the price of the stock compared to the earnings of the company, they are way, way, way out of balance from many other companies. And so, there's almost an element right now where people are saying, hey, SpaceX, it's kind of almost like a meme stock. Like when GameStop went viral several years ago and was just going to the moon not because of the valuation of the company, but because of the online buzz about the company and the stock.
Well, and I think that's where the attraction comes in, and you got to weigh the volatility, right? So a lot of the SpaceX launch, a lot of its money that it's making is actually through Starlink, right?
Yeah.
SpaceX itself is not really making all that much money, but there's also the the OpenAI or whatever. It's all tied in there together. But then you have interesting investors like, I don't know if you saw this, Scott, but this like the richest person in Australia, Gina Reinhart, I think I got her name right. She owns a mining company. She bought $1 billion worth of SpaceX. Well, mining, the moon, Mars, right? You can kind of see like where all these things they're all kind of future, playing this a little bit. So I think for average investors, we just want to get in on it. But to your point, it can be really volatile. And so you just got to be careful about how much you're risking. It's almost like your Vegas money, I would say, to start.
Yeah. I mean, and candidly, like if you own some of the broader indexes, you're going to own some SpaceX because again, they threw it into S&P 500. They threw it into NASDAQ index. So you're going to own a little
eventually,
bit of it.
You're going to get there.
Some of those funds, but you look at historically most IPOs, the data would show that 3 to 5 years post IPO, it is not the exception, but it is the norm that those IPOs are underperforming the broader market. It's the norm.
Yeah.
And so again, if it's something where, hey, I want to put a bunch of money into SpaceX and I want to try to make a quick buck, to your point, that's more like speculating or gambling than it is actually investing.
And maybe the bunch of money is the conversation. Maybe that should be, especially if you're a retiree or pre-retiree, maybe you're not waging too much here, Scott. You're just saying, hey, I just want to get in on something cool. It's a cool company. I just want to buy a small percent. It's almost like your precious metals, maybe no more than 2 or 3%, something like that,
Well, and I think the other thing that a lot of people, don't realize is just because you're putting an order in to buy SpaceX stock does not mean that you're getting it at the IPO price. And so there's a bid ask process when it comes to trading. And, a lot of ETFs or a lot of individual stocks that somebody might trade, they're pretty liquid. And so, when it goes to what we call a market maker actually at the exchange, your broker is like putting a bid price in for whatever share that you're trying to buy. And then there's a market maker that's finding an ask price out there and they're making that, and then they make the money on the spread. And so, ultimately you might think, hey, I'm going to go put an offer in to buy SpaceX. And people might say, I'm going to put it at the market price. Well, the market price is just going to get put in the queue. And as the price goes up, after all these orders are getting filled, they're going to get it at whatever the market price is after all these institutional investors are already in there for lower prices. And so what happens is someone might say, hey, I'm going to put an order in for $50,000 to buy some SpaceX. And that order can sit and go unfilled while the price is going up and all these other orders are getting filled.
Like the $1 billion one, right?
Exactly.
Yeah.
And that's going to drive the price way up with all these institutional investors. And then that $50,000 order is going to get filled after you've missed this huge run up. And so you can look and say, oh, shoot, over the last 5 days, it's up 22%. My account is not up 22%. What happened? And that's what happens. It's because, especially with these larger IPOs where there's a lot of hype, there's a lot of institutional money in there too that's going to get better pricing. And that better pricing is going to drive the price up by the time a lot of these smaller retail orders get fulfilled.
Yeah. And, as the saying goes, a great company doesn't always make a great stock. It could be, eventually, again, all of these, tech stock IPOs definitely had volatile couple of years and when they're launchings. And so I get the attraction. I guess at the end of the day, you want to make sure it just makes sense within your strategy. And again, you've got some of that speculation money, then that's cool, right? But just don't bet the farm here.
Yeah. And that's one part of it. The other part of it is, I encourage people to feel like, you're not necessarily missing out. Again, if we want to own some of that, you're going to own some of it through, potentially a technology holding that you might own or that a lot of our portfolios have. You might own it through a certain index fund. So you're going to get some exposure to it. And again, if you own it through, a Vanguard technology fund that's buying that holding, that's an institutional buyer that's going to get institutional pricing. And again, if you're like, hey, I just want to see a SpaceX ticker in my portfolio,
right.
You can put a bunch of money in there, but again, what kind of pricing are you going to get? Typically you're missing out on that IPO pricing. Because a lot of times, again, when you look at the underwriters that underwrite these initial public offerings, they're going out and they're finding all that institutional money that's going to come to the market and buy those stocks. It's not this willy-nilly process of, hey, I think we're going to go public. We're going to put it out at $150 a share and we'll see who buys it. Oh, no. There's a huge process and a huge body of work that goes into who's going to buy this stock first. They're going to get a certain level of pricing. And then when it goes to the broader market for retail investors, they're getting different pricing because a lot of that price has already shot up.
Okay.
So
what else? What are the things, to kind of take away from the IPO, especially with that FOMO bit, right? That fear of missing out bit. From the pilot standpoint, right? This, I guess there's an attraction there too, right? It's like, hey, this is pretty cool. I want to be involved in this, but again, it's risky, right?
Yeah. And I think too, if we look at set SpaceX aside for a second and just look at IPOs in general.
In general. Okay.
If we look at IPOs in general, again, short term, they tend to underperform. But you do have great companies out there. Apple went public, Amazon went public. And
sure,
there's certain things out there that to me, I would view it as, hey, if you want to bake that into your portfolio and you're like, hey, I'm long on this company. I think it's going to be a huge, huge company. And then you can also do what, you've heard us talk about dollar cost averaging. Well, let's put X amount of dollars per month into this stock. And so we're catching the ups and downs and we're beefing that position up over time.
Yeah.
We don't do a lot of that, but that could be a technique where you get that exposure in a smart, disciplined way, not an emotional performance chasing way. Because again, it's one of those things you can throw a ton of money at it. The order can get filled and the market moves so fast. Again, this is up 21% in 5 days.
Right.
By the time you wire money over to your Schwab or Fidelity account, place a trade and it gets filled, you can miss out on a ton of that performance. Your order got placed yesterday and you're down 5% on a stock that's up 20% this week. And it can be a very frustrating experience for the investor. And that's where I think, you got to understand, hey, you're a retail investor, not an institutional investor. And the more that you can just have discipline and process with a lot of what you're trying to build from a net worth standpoint, an investment portfolio standpoint, the better off you're going to be long term. So again, I'm not saying, hey, don't buy SpaceX or buy SpaceX. I think, again, if you look at the price of the stock compared to the historical earnings and the forward-looking earnings of the company, they are not aligned. But that's okay. Hey, that was probably the case with Amazon as well. I mean, Amazon was losing money for years while they're continuing to grow up. And it's because they're investing nonstop and they got a strong vision for how they're going to grow the company. So you can feel like that and have some confidence there. But again, there's probably a way to go about it, not just with SpaceX, but with any initial public offering. There can be a lot of buzz around IPOs, but the problem is these are private companies. You don't have years of books to study the fundamentals of the company. You look at the Warren Buffetts of the world, they're looking at years of track record and years of how the company has been managed and how the management views the outlook of the company, how they deliver on the outlook. And that's where they're making their buying decisions, looking at the balance sheet, looking at the cash flow statements, looking at an analysis of how they're growing revenue and growing profits. You don't have that in a private company. There's no track record. Yeah. And so, and it's not to say that it's a bad investment. It's just, it's a lot of risk with a lot of unknown return that's going to come in the future. Now, all returns are unknown in the future anyways. So again, I'm not saying I'm anti that, but you do have to resist this fear of missing out. Because again, if you're going to take $100,000 and go put it into this one stock in the hope of doubling it really quick or getting up 20% in 5 days, it's generally not going to happen because, again, you're a retail investor, and the institutional investors that have been part of that discussion on where the target price is and how much money they're going to bring to the table, and they're involved with the underwriters, that's a whole different world happening on Wall Street that most retail investors are not part of. And so you do miss out on a lot of that. So.
Yeah, and Scott, I think, isn't there like some bit of restrictions anyway on a brand new IPO? Like you can't just buy a bunch and then turn around and try to flip it within a few days. I think there's some stipulations there too.
Yeah, and again, especially when you look at those institutional investors, they're typically those I'll almost say like inside or early investors that are part of that underwriting process and saying, yes, we'll come to the market and buy $1 billion, whatever. They're typically making a 90 to 180 day commitment that we will hold the stock for this long. Yeah. Because they know, hey, I'm not going to put $100 million into your stock, watch it tick up 20% and then exit 5 days later. So there's a lot of, and this is, again, not to beat a dead horse, but that institutional environment is very, very different. And they do tend to benefit from that, but they're taking a little bit more risk because, hey, if this thing starts to tank and drop off, they're going to be holding it too, and they're committed to that.
Yeah, and I think that helps the smaller retail investors too. So there's some circuit breakers in place. So just, again, it all comes down to understanding and knowing what you're doing, and not leveraging the farm, so to speak, because you just want to have that FOMO action. If you want to get a little bit, just to say you got a little bit, that's one thing. But as always, check with your financial professionals, your advisors. Make sure you're not deviating from the plan too much, that you've taken the time to build and craft and put in place. And if you haven't taken that time, well, it's a great time to do it. So get yourself onto the calendar, have a conversation, reach out to Scott at retireairlines.com. That's retireairlines.com. And of course, subscribe to the podcast on Apple, Spotify, and of course, right here on YouTube. We'll be back with more stuff as we always do. Scott, my friend, thanks for breaking this one down.
Yeah, my pleasure. And, and I would always just kind of put a pin in this one and tie it back to, so much of our financial success comes from avoiding mistakes. with hindsight, we can always look back and say we could do different things better.
Yeah.
But a lot of looking forward and the success we're going to have in the future just comes from avoiding mistakes that are the tale as old as time, and chasing performance through IPOs or individual stocks here and there. It's one of those things that you can definitely do more harm than good to your portfolio. So it's worth a while to take a cold shower, take a step back, and just follow the plan.
And ponder it a little bit. And we'll see you next time here on the Wealthy Pilots podcast with Scott Osborn. Thanks for hanging out with us.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own Financial Flight Control Toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.